5 a.m. in New York City. Good morning. I'm Bonnie Quinn with your Bloomberg Brief. Here's what you need to know. A major markdown potentially looms. Treasury rallies taking a breather as investors brace for downward revisions to jobs data. Reshaping mining. Anglo American agrees to buy Teck resources in one of the biggest mining deals in more than a decade. And more deals. Microsoft strikes an AI cloud agreement worth nearly $20 billion with Nebius. So let's take a look at those markets, because in spite of everything, potentially a more fragile labour market, slower growth, we keep seeing this rally. Obviously, JP Morgan yesterday warning that we could see stocks tank once this Fed rate cutting cycle starts. But that's not stopping things for now. The Nasdaq Composite Index hit a record yesterday. It was up 0.5% on the Nasdaq 100, and we see futures pointing higher again today. S&P futures also higher, even though the S&P is also hovering around a record. A little weight to the US dollar index. I want to point to oil as well, because Saudi Arabia, as my colleague put it, basically has turned into a supermarket, cutting crude prices across the board, and that would have had an impact on oil, but there are buyers coming in to take advantage, and so oil is a little higher today. Let's look at the bond market, though, because it is really, the last month has been just so fascinating in this bond market. Would you believe global bonds have now entered a bull market? They're up more than 20% from their March 2022 trough. We're talking sovereign and corporate bonds across DM and EM. Today we have yields up about 2 basis points across the board. Not too much movement, but that 2-year yield hugging 350 as we await those jobs revisions. Let's get to some individual stocks to watch now. Here's Valerie Teitel in London.
Good morning, Ivani. Let's start with the merger of the day. Anglo American will be combining with Canada's Teck resources in one of the biggest mining consolidations in the industry. Those shares of Anglo American are cheering this news, up more than 9% in trade here in London. Now, this marks one of the biggest deals that the combined company we valued at around $50 billion, and marks further consolidation in the mining industry where scale really matters. Another area where scale really matters is when it comes to these data centers. We've had another tie-up. Nebius, which is a Dutch AI infrastructure company that is listed in the U.S., is signing a deal with Microsoft to have access to its new data center out in New Jersey. It's a five-year deal, Vonnie, that could be valued at up to $19 billion. Nebius will start delivering this capacity later in the year, and we're seeing shares just fly in pre-market trade, up more than 48% for Nebius. Lastly, let's end with Dell. A bit of a reshuffle at the top. The CFO announced she is resigning after 2 years at the helm. The company, though, the PC maker, came out and said this has nothing to do with any disagreements about financial reporting or financial statements. And to that, guys, and also to help investors back up that confidence, they did confirm their full year guidance when it comes to their numbers. But we're seeing shares of Dell down more than 1% so far in pre-market trade on the CFO reshuffle. Bonnie?
Thanks, Val, and boy, do those deals just keep on coming. That is Valerie Teitel in London. And in just moments, we'll push ahead to the jobs revisions with Vasiliki Pachatouridi of BlackRock. Later this hour, Mark Hackett of Nationwide joins us as Teck leads stocks near records. So, investors repositioning on a surge in Fed rate cut bets. Vasiliki Pachatouridi of BlackRock says risk-taking is not dead. She's head of EMEA iShares fixed income strategy and joins us now. Vasiliki, thank you so much for joining. So obviously global bonds are back in a bull market, and yet we're seeing stocks also surge ahead. Are there risks here?
Well, Bonnie, good morning. What I definitely see is that investors have been ramping up their allocations to fixed income for the past month or so. August was the biggest month on record when it comes to bond ETF flows. And what I see investors is trying to reposition ahead of the Fed cutting, resuming pretty much with certainty next week. So a lot of buying of US Treasuries, definitely intermediate duration, trying to benefit from the Fed rate cuts, avoiding the long end, but also a lot of buying of high quality credit, investment grade. And as you mentioned earlier, high risk taking in fixed income is not dead. Of course, risks do remain. That would be a further slowing of the US growth in the economy overall. This is not our base case scenario. And of course, things that affect the longer end, sticky inflation and concerns around fiscal sustainability they're not going to go away anytime soon.
Sure, but we have seen this massive rally, Vasiliki. So are you advising investors to continue to buy this rally, or is there a point at which they should potentially pause?
Yeah, I think the important question is, where does this kind of allocations back into fixed income are coming from? And what I see in my conversations with clients is that there's a lot of investors that they've still been sitting on the sidelines. Between now and year end, we expect cash rates to continue to fall. So you're starting to see this kind of investments coming from the sidelines, people putting cash to work. The steepening of the yield curves, both in the US and in Europe, have been a catalyst for that trend. And what investors are looking in is to lock in yields that are still at historic highs. So I think that starting point is really important. And it's really kind of hard to ignore opportunities in the US, of course, but also internationally. Demand for European bonds is still very high. Emerging market debt. So I think we're in a moment where being selective, having a diversified portfolio of fixed income yielding assets is probably the thing that I see most investors looking for.
You know, it's interesting. Yesterday, the Goldman Sachs CEO, David Solomon, was speaking at a Barclays Financial Services conference, and he signaled that there's absolutely no need for the Fed to rapidly cut interest rates. Let's just have a quick listen to one of the things that he said.
It doesn't feel to me like the policy rate is extraordinarily restrictive at the moment when you look at risk appetite. And so, risk appetite is definitely, out on what I'd say is the more exuberant end of the spectrum.
So a little worrying perhaps there, but Vasiliki, is he right if monetary policy is not exceedingly restrictive, or if the head of one of the major banks doesn't feel that way, will the Fed be one and done for the moment?
Well, taking a step back, I think that policymakers and central bank and the Fed, they're facing a really tough trade-off right now between kind of growth and inflation. Clearly, we do see some Fed cuts coming through this year. We're leaning towards like a back-to-back maybe between September, October, and December. But over the longer term, I would agree that maybe over the course of 2026, we would stay cautious of a kind of a more dovish narrative, because yes, risks still kind of persist, uncertainties around inflation, the impact of tariff, fiscal sustainability. But as I said, I think policy kind of trade-offs and uncertainty are featuring through the macro environment. And it's why we have been long proponents of staying lighter on duration in portfolios and thinking about fixed income for the purposes of generating quality income in portfolios.
One of the more interesting things you're seeing too is that demand for euro bonds, or bonds denominated in euros, is actually, increasing quite substantially as well. Why is that? Is it a concern for Europe and several European countries, or is it the opposite, animal spirits?
Yeah, so I think there's a couple of parameters. Maybe an obvious one is kind of the currency dynamic. So people kind of buying European bonds or international bonds from the US in either an FX hedged way or an unhedged, kind of capitalizing on dollar weakening. But coming closer to my hometown here in Europe, I also think of course, there's a lot of uncertainties here in Europe as well. This morning we were talking about French risks in particular. But when it comes to the monetary policy, there is a little bit more of a kind of an expectation that the ECB is on a more certain path in terms of kind of rate cuts and where they stand for now. And again, kind of the yield picture here in Europe has kind of improved significantly from the depths of kind of being in negative yielding territory just a couple of years ago. So a couple of parameters, fundamentally kind of stronger markets, the yield level, but also things like technical buying and the FX story.
So Vasiliki, if you are of a mind to take risk, and clearly those investing with you are, where outside the developed market would you be looking right now?
So I think emerging market debt has been an asset class that has been so under-owned for many years. And even kind of from the kind of currency dynamic point of view, obviously we've seen significant weakening of the dollar this year, but that has been mainly relative to DM currency pairs. Perhaps if we're positioning for more weakening of the dollar, that could be more towards kind of emerging market pairs. And again, emerging markets have really grown, and they are on a path of a more sustainable future, creating opportunities for kind of steadier and quality yields in there. The other side of the picture is obviously I've spoken about the flows that we see in high quality investment grade credit that has been kind of very strong. But let's not forget that IG credit is highly owned in portfolios right now. So pairing that up with opportunity, for example, in the securitized space, CLOs is an asset class that has opened up to a lot more investors, given the kind of the invention of kind of ETFs and easy to access vehicles to capture opportunities in the loan space.
Vasiliki, thank you so much for joining us this morning. That is Vasiliki Pachatouridi of BlackRock. Now to other top stories trending on the terminal this morning. Microsoft struck a multi-year deal worth nearly $20 billion to get AI cloud computing power from Nebius. The agreement represents a massive windfall for Nebius, which has been working to capitalize on the AI frenzy. Microsoft didn't say how it would use the Nebius resources and didn't immediately respond to a request for comment. And a once unthinkable takeover that's set to reshape Italian finance. Monte Paschi has secured a majority stake in Mediobanca in a deal worth $18.8 billion. The deal is set to create Italy's third largest lender by assets. ASML is investing €1.3 billion, or about $1.5 billion, in France's Mistral AI. With the investment, ASML becomes Mistral's largest shareholder with an 11% stake. Coming up, one of the biggest mining deals in more than a decade sends the sector higher. We'll bring you those details next. This is Bloomberg. This is Bloomberg Brief. I'm Bonnie Quinn in New York. Shares of Anglo American getting a boost after striking one of the biggest mining deals in more than a decade. Anglo confirming this morning that the London-based firm has agreed to buy Teck resources, creating a more than $50 billion company. Let's get the details now with Bloomberg's Martin Ritchie, who covers metals and mining. So Martin, what do we know about the deal, and why does Anglo want Teck right now?
Yeah, as you said, one of the biggest mining deals that we've seen being put together for a long time. Certainly, if it goes ahead, it will create a company probably worth more than $50 billion, among the top copper producers in the world. And it comes after a few years, really, of attempts to make these big mega deals in the mining space. Back in 2023, Glencore tried to take over Teck. Last year, we had the huge deal with BHP trying to take over Anglo. And all of these kind of in one thing in common. It's about trying to combine copper assets together. It's the one thing that the big mining companies want to get more of. Now, just to talk you through some of the details of this deal, it is a no premium merger. And the Anglo shareholders will get 62.4%, Teck the rest. Talking about synergies, they say $800 million in sort of cost synergies, and then $1.4 billion in potential operational synergies after going into the next decade annually. The company will be based in Canada. They've really stressed that point. I think that speaks to the fact that it will have to be obviously approved by Canada's government, saying there will be no net job cuts in Canada. The senior staff will be in Canada. But just the overarching strategy, as you see in what they've announced, it's all about copper. They mention it so often. Company will have 70% of its business basically copper focused.
Well, exactly. So two questions really. Does this protect Anglo more? Will it, get more bids because it had to fend off that bid last year from BHP Billiton, and sometimes, companies come for it? And also, what does it mean for copper more broadly?
Well, obviously, the next thing that people are looking at is, will there be any competition for Teck? BHP, as you said, tried to take over Anglo last year. That transaction was very complicated because Anglo was a kind of sprawling, very diversified company. It is in the process of simplifying itself at the moment to become a much neater company without some of the coal, the diamonds, the nickel business that it used to have. So we'll have to see whether there's any other company waiting in the wings. And certainly, since the BHP swoop on Anglo last year, there's been all sort of talks about who can take over who in the mining space. So everyone's running a rule over each other, and you have to wait and see if there's any competition in terms of coming out for Teck.
It's fascinating, Martin. No doubt we'll be back in touch with you very soon. That is Martin Ritchie there covering that deal for us. So let's take a look at those mining stocks. As you can see, Anglo itself is trading up almost 10%. We also have Glencore on that halo effect. Of course, Rio Tinto down just very slightly. And generally, the mining space expected to do pretty well today. Coming up, a search for a new French Prime Minister. More on President Macron's top contenders next. This is Bloomberg.
Parce que, mesdames et messieurs les députés,
ladies and gentlemen of the Assembly, you have the power to overturn the government, but you do not have the power to erase reality. The expenses will continue to increase even more, and the enormity of the debt, which is already unbearable, will get heavier and heavier and more expensive.
European stocks muted as French President Macron moves to appoint a new premier within days. Joining us now from Paris is Bloomberg's Caroline Conan. So we saw the outgoing PM obviously try to warn everybody of the risks, but at the moment the market seems to be pretty sanguine. What risks does all of this pose to the market, Caroline?
The reaction on the market has been quite muted because obviously Beirut's collapse was mostly priced in. Now, of course, what investors are looking at right now is who this next prime minister is going to be. And if it's a socialist government, then are we going to see the budget proposals, the budget savings watered down? You know that François Bayrou, the former prime minister now, who's handing his resignation today to President Macron, was proposing more than 40 billion euros of savings. The alternative socialist budget is proposing 20 billion, so it's basically half. What does that mean for the debt trajectory of France? Of course, that means that delaying the return to a 3% deficit target by 3 years, that may worry investors, or perhaps markets will just be good with some sort of stability if they can find a compromise. A compromise, of course, that will be hard to reach, given the socialist and the center have a very different vision on what it means to tighten public finances.
Well, if you look at sovereign debt, Caroline, the spread to Germany, for example, is at the levels that it was at during the crisis. Now, that could all, you know, the air could come out of that pretty quickly, depending on who Macron chooses. Who can he choose from right now?
So what he's tried before is obviously the right-wing Republicans with Michel Barnier. Then he tried the center with François Bayrou. A socialist prime minister is something he hasn't tried for. So obviously a lot of people are saying that if he does again choose someone from within his own camp, such as, for example, the defense minister, Sébastien Lecornu, who's been cited as one of the contenders, it's going to again anger the moderate left wing and perhaps even anger the streets. Because you have to remember, France is also facing 2 days of national rallies. Tomorrow, there is the threat from the far left to block the country. And then next week, a more structured day of strikes coming from the air, from the trains, even from schools all across the country. So if the social anger mounts, if we are facing perhaps the beginning of some sort of yellow vest crisis, like we saw back in 2018 during President Macron's first mandate, perhaps going the socialist route might be be a way to calm the social anger in the streets, to give something to these people who are asking that it's not only the president of the rich, which is Macron's nickname,
yes,
that they are looking at, but also a government who actually cares about their day-to-day struggles.
Caroline, we will definitely check in with you again very, very shortly, developing a story there in Paris with Caroline Conan. Time now for your front page news. First up, on the New York Times, the House Oversight Committee released files turned over by Jeffrey Epstein's estate. The files included a copy of a suggestive note apparently signed by President Trump. The president has denied composing the message, and the White House Deputy Chief of Staff said the image is fabricated. Next up, the Wall Street Journal reporting OpenAI executives are getting concerned that mounting political scrutiny could derail efforts to become a for-profit company. According to the Journal, the executives have discussed a last-ditched option of moving out of the state. And on the FT, the world's biggest oil and gas companies are cutting jobs and slashing investments at the biggest rate since the COVID market collapse. Companies including Chevron and BP have tens of billions of additional cost savings promised, with some projects paused or put up for sale. Coming up, signs of exhaustion in tech. We've been saying it for a while. It's still there. That's according to Mark Hackett of Nationwide. He's going to be joining us. Plus, we're going to be keeping an eye on these markets as we await jobs revisions just a little later on this morning. This is Bloomberg. It's 5:30 a.m. in New York City. Good morning, I'm Vonnie Quinn with your Bloomberg Brief. Here's what you need to know. A major markdown potentially looms. Treasury rally taking a breather as investors brace for downward revisions to jobs data. Reshaping mining. Anglo American agrees to buy Teck resources in one of the biggest mining deals in more than a decade. And more deals. Microsoft strikes an AI cloud agreement worth nearly $20 billion with Nebius. So even as we hit markets yesterday, we continue to point higher today. The Nasdaq Composite Index was at a record yesterday. 100 futures up 0.2% now, and S&P futures pointing to a gain of 0.1% at the open, in spite of the JP Morgan warning that we could see a massive sell-off if indeed the rate cycle begins, the rate cutting cycle. A little bit of weight to the dollar index once again today, 0.2%. But let's look at global bonds, because we are now out of that bear market. We're in fact in a bull market for bonds. Globally, if you look at sovereign bonds and corporate bonds across the world in DM and EM markets. Today, though, we have the 2-year yield up just more than a basis point, the 10-year and 30-year yield up 2 to 3 basis points apiece, still hugging that 350 there on the 2-year yield. Massive move in bonds the last 30 days. Let's get to some individual stocks to watch now before we talk more about fixed income. Here's Valerie Teitel in London. Valerie.
Good morning, Ivani. Let's start with that mega merger in the mining space. Anglo American and Teck Resources out in Canada will be combining into a company worth more than $50 billion, one of the biggest tie-ups in the mining space in the last decade. We're seeing shares of Teck Resources up over 10%. We're also seeing shares of Anglo American over in London cheering this merger news as well. That marks further consolidation in the mining industry, where scale really matters to bring down costs. Another industry where we're seeing a big tie-up and a big investment is over to Microsoft. Nebius has agreed to some data leasing. It's a data AI infrastructure company. They've agreed for Microsoft to have a 5-year lease when it comes to the data center they just built out in New Jersey. We're seeing shares of Nebius up over 50% in pre-market trade. It's a 5-year deal valued at some $19 billion. Lastly, let's end with Dell. A bit of a reshuffle at the top. The CFO announced her resignation, but the PC maker out with a statement quickly after. This had nothing to do with any disagreements when it came to financial statements or financial regulations. Dell is down in pre-market trade, down 1%, even though the company did try to bolster confidence by reaffirming its full-year guidance. Bonnie?
Valerie, thank you so much. That is Valerie Teitel there in London. Well, markets are bracing for a downward revision of U.S. payrolls data through this April, coming at 10 a.m. Eastern. Here to take us through it is Michael McKee, Bloomberg's international economics and policy correspondent. So, Michael, these are the revisions for previous months coming out at 10 a.m. Eastern. What matters? Is it the aggregate number or the individual months, or how will traders read this?
Well, you look at the aggregate number because we don't get the individual month breakdowns now, but this is an annual event where the BLS rebenchmarks its jobs numbers against unemployment insurance records to make sure that they're as accurate as possible because, of course, the numbers they produce on a monthly basis are based on survey responses. So this is actual data, just comes in slower, so they can't use it at the time. And what they do is go back and figure out what the total number of people on payrolls is versus what had been reported through the surveys, and then the difference is what Wall Street is going to be watching. And the guess is that it's going to be somewhere near 600,000 to 800,000 jobs fewer in that period of April 2024 to March 2025. And we get a final report on that when we get to January, and we do this every year. They update the numbers and they allocate to each month.
And of course, last time we got this, it was a downward revision of 818,000, and it caused kind of ructions in the market, which is one of the reasons why we're so closely watching it today. What would it take for there to be a jumbo rate cut on the table next week?
Oh, this isn't going to affect that at all because the Fed knows about this and they understand what it is. This isn't a change in the current situation. This is a change in what happened over the past year, and you got to go back over the past year before April. So it's just basically an updating of the statistical numbers. Now you have to remember, too, that there more data will come in. Last year, as our chart showed, there was 800,000 roughly in the initial estimate that we got in September of last year. The final was 589,000, and economists expect the final revision to be lower than whatever we get today as well.
So the downward revision could be revised back up a little bit, is what you're saying?
Yes. Michael,
thank you so much. Full of context. And of course, Michael will be taking us through those numbers at 10 a.m. Eastern here on Bloomberg Television as well. That's Michael McKee there. Nationwide's Mark Hackett is writing this today. We expect signs of exhaustion in the large cap tech space. That said, investors are aggressively buying dips, confusing institutional investors and disincentivizing absolute or relative short bets. Mark Hackett, Nationwide Chief Market Strategist, joins us now as Michael McKee walks off set there. And thanks, Michael, for all of your contributions. So, Mark, signs of exhaustion, we've been seeing them. It's not stopping the market. The market doesn't care that it's exhausted.
Well, certainly the tech stock rally that we've seen over the last couple of years was warranted in a lot of ways. I mean, the earnings growth rate, the secular demand story, even the margin expansion warranted outsized performance relative to the rest of the market. This year, though, it's been a lot less clear that direction. We have right now 11% return for the Magnificent Seven and 11% return for the other 493. So we haven't anymore seen this tech-led rally, although the news cycle certainly focuses on that. When we look forward, however, the growth rate gap is narrowing very dramatically at the same time that the valuation and performance gap is quite wide. So the risk-return profile works a lot better for things like small caps, some of the value space, financials, industrials, some of the areas that have been stronger lately.
The problem is that we've been waiting for that to come true for so long that at some point, do you just capitulate?
Well, capitulation, we're not looking necessarily for a tech collapse. What we're looking for is hopefully somewhat gradual handoff in leadership from tech to everything else. I think you're starting to see some elements of that recently, so we're not necessarily looking for any degree of a collapse. But the leadership shift should be subtle. A lot of the reason we haven't seen that shift in any persistent way has been the instinct of retail investors in times of stress to just gravitate towards that technology space. So it's a bit of a comfort blanket, one that in the short term certainly seems like we would see dips. But again, we're looking not necessarily for a collapse and an acceleration, more of a subtle shift.
It's fascinating because you say that it's confusing institutional investors, and yet surely it can't be all retail holding up this rally.
Well, it's not necessarily retail. What it is the retail investor causing some sort of reaction from the institutional investor. So if you look, the microcosm of this was earlier this year following Liberation Day, where the institutional investors did what they thought historically was sound, which is move to the sidelines and wait for some sort of development. The retail investor did not act like they historically act, in that they would normally be the ones capitulating towards the end. They were actually buying that dip very aggressively. What that did is it put the institutional investors that, as I said, were either absolutely or relatively short. They were on the wrong side of that bet. They had to close that gap. Right now, we're not seeing them in any excessive positioning. It's just much more back to neutral. But the retail instinct to buy dips, and doing so with leverage like things like triple levered Qs and options activity, it's just moving that incremental institutional investors' confidence level more towards the middle.
You know, I mentioned earlier JP Morgan was saying that we could see stocks tank once the rate cutting cycle starts because, you know, most of this is priced in. But if it is priced in indeed, then why aren't we seeing, you know, rate sensitive stocks improve?
Yeah, I don't know that we necessarily have seen it priced in for the cycle. I think certainly this September rate cut is priced in. But, you know, the rate cycle, historically, we see about a 20% average return for the market when the Fed is in rate cut mode. That's much better, obviously, than 16% on a steady or a -6 when rates are rising. So, you know, the easy bet here is to say that the tailwind is behind us because the Fed is in rate cutting mode. That caveat, though, you know, the JP Morgan piece kind of addresses this a bit, which is this cycle really hasn't followed historical patterns. So having direct confidence that this will happen because it's happened in the past really hasn't worked very well, frankly.
So what would you be advising at this point to, you know, dip your toe into some of those other stocks that haven't really performed as well, or to sort of go full on, just go raw into all of those stocks?
Yeah, our recommendation would never necessarily be to switch on dimes. This is a little bit of a subtle shift. So we're not, like I said, we're not looking for a collapse in technology, and we're not looking for some sort of, you know, crazy rally in the small cap space. We're looking for things where the tech space maybe moves sideways for a little bit here and the rest of the market catches up. So overall index returns may not be what we've seen over the last 3 years, but if you're creative and you move into some of these better risk reward bets, you can actually do fairly well.
But, you know, it's so exhausting, right? Because every time you see this rally in tech and sort of the typical trade that we've been used to for the last 2, 3, 4 years, you know, then you get the Russell 2000 rallying and you think, okay, we're off to the races. But then when we have a sell-off, it's the Russell 2000 that performs much, much worse than the other indices. So how patient do you need to be here?
Well, a lot of this is going to depend on the earnings revision trends. So historically, when the small cap rally has happened, or even the value rally, or even the international rally, it hasn't followed through with earnings to back it up. This time, we actually are seeing estimate revisions turn higher for the small cap space and for the non-tech part of the large cap space. That's very encouraging. We certainly need that to continue, and that I think will be the ultimate driver in whether or not this forecast comes true.
Now, you also see significant tailwinds developing, including, you know, fallout from the OBBB, as well as a new Fed chair. Why should they be tailwinds necessarily?
So normally we'd think of right now as headwinds from a seasonal perspective. That actually hasn't happened the August-September period. But as you move forward, historically, seasonally, you get a tailwind in the fourth quarter and the beginning of the following year. But there's a cascade of events that are happening over the next 6 to 12 months. You know, first, as you mentioned, there are some embedded benefits from the recent budget bill that passed, but there's also a lot of purchase agreements embedded in these trade deals that have happened. Some of the longer-term investment stories are a little less clear if they'll happen, but the near-term purchase agreements will be a tailwind. On top of that, you do have this dovish shift from the current Fed, but also perhaps an even more dovish shift as we get a leadership change early next year. And then finally, the weakening dollar is a tailwind for their earnings, but also our exports as well. So there's a lot of tailwinds that we are currently seeing that we frankly haven't seen for a while.
All right, Mark, thank you so much. Looking forward to seeing if those prognostications come true. Thank you. That is Mark Hackett of Nationwide. Now, two other top stories trending on the terminal this morning. Goldman Sachs wins a $40 billion mandate from Shell to oversee its pension assets. This is one of the biggest outsourced deals of its kind. Goldman will oversee pension money in Europe and provide advice on North American pension plans. Rupert Murdoch and his children have resolved their succession feud. The settlement hands eldest son Lachlan Murdoch control over the media empire, which includes the Wall Street Journal and the Fox broadcast network. Murdoch's other 3 children, Prudence, Elizabeth and James, will cede their stakes and receive about $1 billion each. Bloomberg sources say BOJ officials are of the view that it may be possible to raise the benchmark interest rate again this year. The US-Japan trade deal has removed a key source of uncertainty, but the BOJ is likely to keep its rate unchanged at 0.5%. Coming up, Deals Tuesday. Microsoft inks a $19 billion cloud computing agreement. We'll bring you those details next. This is Bloomberg. This is Bloomberg Brief. I'm Bonnie Quinn in New York. Shares of Nebius soaring pre-market as Microsoft strikes a deal worth up to around $19 billion to get AI cloud computing from the firm. Joining us for more is Bloomberg's Subrat Patnaik. Subrat, what do we know about Nebius and why Microsoft might have chosen Nebius for this deal?
Morning, and thanks for having me. Nebius is not a household name for us, but it's got a rather interesting background. So it's spun out of Yandex, which is a Russian internet giant, and now it has backers that it counts like an NVIDIA. So it's a company that's known in the industry, and the deal's a pretty big one for the company. But more importantly, it's quite big for the industry as a whole because it shows that AI demand is not relenting, and we've seen Nebius rally 50% pre-market, but we're also seeing rivals like CoreWeave rally like 5.6% this morning. So analysts are pretty bullish on the deal, and Microsoft has said recently that it is still constrained when it comes to like AI supply chain and AI infrastructure. So as hyperscalers kind of build this out, we might see many more such deals, multi-billion-dollar long-term deals with AI companies.
It really is fascinating, given the valuation as well. What does it mean for Nebius's competitors, given that Microsoft maybe now doesn't need to go to them anymore?
So I don't think that's the case because demand has, for now, not showed any signs of peaking. So there will be a lot more deals being struck. That's why we're seeing rivals rally as well. And analysts are saying that this is a very positive sign for the industry on the whole. But we'll see many more companies like Amazon, Meta, who is funneling like billions of dollars to like build out their AI infrastructure, striking similar deals.
Subrat, a quick word on Apple's annual product launch today. What will we be watching for?
I don't want to sound like an Apple events Grinch, but the stock might be a dud this morning. It's been happening over the past few years just because we are reporting every single detail of the run-up to the event, and this year has been no different. We have a very detailed report of how many phones, how many watches, the prices, everything is out there and priced into the stock, and we've seen the stock rally around 400 billion since July end. So I won't be surprised if the shares are a dud on Tuesday, like today. But yes, it is the single biggest day for Apple in terms of hardware updates and some very exciting products coming out today.
All right, well, go read our coverage. I think that's what you're telling us, Subrat. Thank you so much for joining. Subrat Patnaik in London there. And more deals this morning. Anglo American confirming this morning an earlier Bloomberg scoop that the London-based firm has agreed to buy Canada's Teck resources, one of the biggest mining deals in more than a decade, and it's sending both companies' shares higher. Joining me now is Neil Campling, Bloomberg senior equities strategist. So what do we know about why Anglo wants Teck?
Well, it's interesting actually that you've just been talking about demand for AI, and I think actually there's a link here to AI here because the most important base metal requirement for AI data centers is copper, and this deal is really all about copper because it can take between 15 to 20 years to bring a new copper mine to fruition. So this is combining primarily around copper assets, I think. So that's the primary attraction for this deal, bringing Anglo to acquire Teck.
Now, we were chatting about this earlier and curious as to whether, there are other people that could come in and maybe make a counter offer.
Well, it's interesting actually because both companies here have been the subject of bids before. Obviously, BHP have gone after Anglo's last year, and the prior year to that, Glencore went for Teck. So the two companies have been the focus of bids before, and I think we're discussing with analysts this morning that maybe even someone like a BHP may well be interested in coming over the top. I think one conclusion to draw on this over the long-term environment is because of the strategic asset that copper is, that we'll expect to see more, I think, in-market consolidation of the miners over the long term. And let's not forget that Anglo has been kind of right-sizing its portfolio since the failed bid from BHP to sell other assets, so that it becomes actually sort of more attractive itself as a bid target in time.
Neil, let's just assume for a moment that it all goes through and that we have one big combined company. What does it mean for copper, the copper industry?
As I say, because it takes such a long time to bring new copper mines to sort of full capacity, I think the strategic assets are very clear, but we need more copper capacity. We haven't really got enough to meet demand, given the explosion in AI data centers. So I think that this deal, assuming it gets completed, will take 12 to 18 months. And then I think it becomes a very, very valuable sort of strategic commodity and asset, and we'll see more deals in this space as a result of that demand that I mentioned.
Who would be next, Neil? Who should we be watching for?
So I think that if we think of some of the other combinations in this space, then I think BHP will likely get out the checkbook, as it were. Glencore could certainly be in throes of a potential asset that could be acquired. And I suppose if we look out to a wider play, then other considerations into the other metals may also be present. But we definitely think that by speaking to some of the analysts out there on the street, that mining M&A is coming back to the fore again, as evidenced by this being the largest deal, as you mentioned at the top, in over a decade.
Yeah, and those stocks rallying. Anglo American up almost 10% now. That is Neil Campling there. Thank you so much for joining. Coming up, payrolls revisions and Apple's product event. We'll get you set up for your trading day. This is Bloomberg. This is Bloomberg Brief. I'm Bonnie Quinn in New York. Now, a look at what's ahead today. Preliminary revisions to the non-farm payrolls data for all the year through March of this year, coming in at 10 a.m. Eastern. Then, $58 billion worth of Treasury 3-year notes go on auction this afternoon. We'll be watching that. And of course, we'll be watching a keynote speech at the Apple event, which begins at 1 p.m. Eastern Time. Bloomberg Teck, by the way, will be live from Cupertino for all of that. Now let's take a look at some movers this morning. Nebius moving on news of an AI cloud computing deal worth up to $19 billion with Microsoft. On the move, it's up 51%. Teck Resources is moving higher on news that Anglo American is set to buy the Canadian miner. It's up 11%. Anglo up nearly 10. And Dell, the CFO there, stepping down after nearly 30 years at the company, 2 years on the job. That stock down about 1%. It's the macro we'll be watching today, though, ahead of the revisions. And of course, before the CPI on Thursday as well, which will be all important. We are seeing just Treasury slipping a tiny bit, couple of basis points apiece for the 30-year and the 10-year. Let's take a look at futures, though, because we continue to rally. The Nasdaq Composite hit a record yesterday. Don't forget. That's it for Bloomberg Brief.